Thank you for taking the a few minutes to join us live. I know it's a lot of work to join these things live, but we always appreciate it when you're on. And for those of you watching on recording as well, thank you for giving us a few minutes to kind of walk through the markets. So what we're going to do is we're going to go through some outside markets here first today, and then we're going to get into corn, wheat, and beans as always to give us our directional bias. And I guess I'll just kind of start with the end, which is that we've flipped our mindset completely, and we are now looking lower across all of our markets that we trade, because and I don't think like the sky is falling and it's going to happen immediately, but I do think that we've shifted completely in the way and manner in which these markets are trading. One of the things that we look at pretty closely on a day-to-day basis are market internals. The short-term structures, the volumes, the just kind of the way these things behave. They all have different personalities, and there's a distinct difference over the last 10 days versus the last 2.5 years, and that is causing, and I think what that is supporting and convincing evidence that the market has certainly shifted to a more bearish commodity mindset. So we're with it. I know it's really hard to shift that mindset, and so I want everyone just to be aware that, hey, these things can go back down, and they can go down just as fast and just as furiously as they went up. So what I've got in front of you is a chart of soybean oil, and if you remember last week, we were really pretty bullish last Wednesday. I mean, we thought, oh my gosh, there's dryness in Argentina. The supply fundamentals are bullish, and the demand fundamentals might be a little bit bearish, but China's got to eat, and everyone's got to come in and import. So we've got to be looking to the upside. And then from an energy perspective, we thought, oh man, China's going to reopen, and that's going to jumpstart the world economy, and we're, these things are going to put premium in it. Well, and then this day happened. Man, what a convincing argument, and certainly the way things were written last week, that's exactly what you thought. And then this day happened in soybean oil, and this was the day that soybeans broke as well, and worked themselves much lower. And this is what can happen in these markets. I mean, soybean oil, every analyst that I follow was looking higher, and they were looking for this market to accelerate back up to the summer highs and unwind all of this down action that happened through the summer. And it just didn't happen. And so this is very impulsive. It's very high volume, and I don't think it's anywhere near done going down yet. And so, and if you look at oil, it looks very similar. Oh, come on, computer, give me my chart. Okay, here's crude oil, right? Same thing. It's just pretty much straight down. We've broken all of this critical support, and you got to be looking lower in oil as well. Now, recently though, soybeans have been rallying. They were up 35 cents yesterday, and everyone's like, well, my gosh, the bull market is back on. Well, here is what's going on in soybeans, and this is the best understanding that I have as of 7:33 this morning on December 7th. So what we have is a situation in Argentina. Argentina is the world's largest exporter of soybean meal, and for the last year and a half, our markets have rallied soybeans based on an oil-led rally, because of RFS mandates and those kinds of things, right? So we've got to so we need to increase our soybean production in order to meet domestic demand. In order to do that, we push those crush margins really, really wide. But what we've done through that is our traders have been long soybean oil, long soybeans, and short meal. And so our meal market has not been very good, and it continues to be that way because we're crushing the bean for the oil. And so our meal market is is not tight. And in fact, as this rally has unfolded in meal, our cash markets have started to weaken. Now, so why is it going parabolic like this? Well, the reason is because of Argentina. Argentina exports a disproportionate amount of soybean meal relative to their production and relative to world supply. And they have kind of a double storm going on down there. They've got dry weather, and the crop seems to be getting trimmed, so that's adding some strength there as traders pump some premium into it. Secondarily, they have just overwhelmingly high inflation, as high as 90%. And so that makes the owners of commodities tight-fisted with them, because the commodities tend to be a hedge against their currency. So you've got tight-fisted producers, you got tightening supply out of there, and then you have the trifecta of the U.S. domestic market unwinding their soybean crush spreads, where they're getting crushed in oil. Soybeans are rallying, so their crush margin is getting hammered. So while it looks on the soybean chart like that is a really bullish development, right? I don't think it is at all. I think it's actually the worst possible thing that could happen to beans from a macroeconomic standpoint, and it's probably going to end very, very badly. Because what the bull case initially started with on both corn and beans was new demand out of China. We had the phase 1, phase 2 trade deals under President Trump, and China was hungry and they needed to buy it. So they bought. And then the world got slammed with a couple of years of drought, which we're still in. Nothing's been busted there. But the world has managed that from a price perspective, and it's rationed demand in the right spots. And so what we have this year coming out of Brazil is a record crop, or near record. In fact, if you compare this year to last year on soybeans, we are dealing with an excess billion bushels of corn or of soybeans over last year, which is not going to bode well if you have softening crush margins here in the U.S. and you have ample soybean meal supplies here. So if our market rallies and we start to move that meal, we can plug the gap out of Argentina, and Brazil will certainly have plenty of soybeans left. So from a just from a simple math perspective, with the size of that Brazilian soybean crop, you have to assume that we're going to end up with higher global supply and higher domestic stocks than what we had previously thought. It hadn't happened yet, and this market has not rolled over, although it really looked like it might yesterday or last week, but it hasn't done it yet. In fact, yesterday's price action came all the way up and took out the high here set on December 1st. And so it's really, really tempting to want to step in and buy this market. And it's a little bit, it's not a little bit, it's a total contradiction to what we've been talking about, which is anything above this line, we're bullish soybeans. But I think with what's happening in corn, with what's happening in soybean oil, I really think what's happening is we may push up into new highs and come challenge this high right here. But I don't think we're going to be able to muster much above that, just because of the weakness on the rest of the chart. So we are looking to be sellers of soybeans, and it's going to take something fundamental to shift that. And well, what if China comes in and buys 3 or 5 million metric tons of soybeans? Well, that might do it. To be honest, if they come in and really accelerate their purchases of beans and corn, and don't just kind of string us along until Brazil harvests. If something like that were to happen, then maybe we'll change our tune. But we'll see that in the price action, because we'll be up above here. But the combination of everything going on here is I don't think it's bullish action, even though prices are up. I think people are just getting squeezed with their profit margins that they've got set up. So we're looking to sell. We'll probably sell against this high. I think we'll sell against this high, and we'll sell against each of these intermediate highs all the way through. We're going to be using tight stops, but we're going to keep selling it because this thing's going to roll over, and when it does, it's going to be fairly dramatic. So what I want to talk about there is, okay, so what's our target? Well, this is the highest point in this correction, and if you take that target, where are you talking on soybeans? Well, we're talking all the way to $12, possibly all the way down to $11.50 on beans, and these are just Fibonacci retracements off of this peak right here, okay? And I think that if we do that, we could break it really fast. So what's the best trading strategy? Well, I think the best strategy is to just sell against this top of this range. And if we get up above it, I think we need to defend it, of course. But until something fundamental shifts, then I think you got to just be prepared that we're looking lower in beans. And when this thing does roll over, we want to be early to it, because it might look like 4 or 5 days of that. It might look like soybean oil, just basically a vertical drop on beans. So I just, in this business, sometimes you got to recognize, hey, that could happen, and we don't want to be on day 3, 4, or 5 when it does. We want to sell early, and we'd rather have to defend it up in here, because that move can happen really quick. All right, now let's look at corn. I want to stop with or start with March corn, because March corn really rolled over. This line is a line that we've been looking at a long time, because it intersects multiple points all the way back through. So in technical analysis, simple is really good. And if you have a price point that has either been support or resistance multiple times, and one day we went back through and counted this a few weeks ago on Market Chat, and it was like 7 different times this market has held or been rejected at this price level. And so we've wanted to identify that, and we got it last week. December corn broke it on this day, March followed the next day, and selling has accelerated on down. And the problem with this move is that you've got this double trend channel set up with a steepening slope. And so the way you would count this from an Elliott perspective is 1, 2, 1, 2, and what follows is a very nasty 3 that can take us all the way back to these summer lows down at 560. And ultimately, this move likely won't end until corn is trading somewhere near the $5 mark. And I know we hate to say that, but this risk is real, and this is exactly why we wanted to just move quickly when it did break this. When you're wrong, you're wrong. You got to pivot. And so we thought long above this line was prudent, but we also knew and have been saying that if it breaks it, we want to get short. So that's why we moved very quickly on these 2 days right here to move out of all old crop and get completely hedged in new crop as well. And what will change our minds on lifting that hedge is a move back up above. Let me pull up new crop here. Same setup, right? We want to be hedged. New crop hedges, we'll want to re-own those with a move probably back above 620. I think it's got an awful lot of hard work to get to that point, but because we've fallen out of this base channel, you've got to look down in this market until something else can shift it and materialize it. And I really believe that this, if I put relative retracement up here against that peak, we'll see where it counts to. This counts December corn down to 480 and right at $5. So that's too much risk for us to, in good conscience, say, no, let's keep playing the long side. We need to shift. The other thing that you've seen, and you may have witnessed in the last few weeks, is from August of 2020 all the way until a few days ago, you would see weakness in the night and then consistent and steady buying throughout the day. And with very few exceptions of a few days here and there. What we're seeing now is the exact opposite. You're seeing a weak strength in the night and then persistent selling throughout the day. That's why you saw a day like yesterday where we were up 4.5 cents, and then all of a sudden, boom, we're down 3, right? And it was like, and if you look at the short-term charts, it wasn't a steady sell-off. It was just boom, we're done, we're going to take it away. And so that's exactly what a downtrend would look like versus an uptrend, and that has all shifted in this time period right here from just a trading perspective. Okay, so now let's talk about Kansas City wheat. It's important, even for those of you that don't even know what wheat is and consider it to be a weed. It's important for you to understand what's happening in this market too, because it directly affects corn supply and the corn balance sheet. And the reason it does that is because feed wheat will compete for corn or extend it and provide some support to corn in the feed rations in Western Kansas. Now, we've been looking at this for a long time, and yes, all this fell off, but yesterday we violated and broke the downside of this trend channel, and today we're getting a little bit of a bottoming signal. Now, here's the problem that we have, is that we don't have a good bullish divergence to trade against. So what we've seen is that on this move, the strength and the momentum has accelerated, not weakened. And that's the exact opposite of what we want to see. So a rally back to the midpoint of this line right here, which would be, let's call it 869, 870, right back to these lows. That's where we've got to hedge wheat. A rally back to that midpoint, because with the momentum accelerating and the way the manner in which price is unfolding, a short-term rally right into here is something that's got to be sold, because wheat can go much lower. Think about it. If corn drops to $5 and beans drop to 12 or 11.50, and where's wheat going to be? Right? You just got to think about that holistically and realistically, and recognize that wheat's probably under 6, and probably is trading with a 5 handle, closer to parity with corn than not. So I know that's not what anybody wants to hear at all, but we want to see a little bit of a rally. I really wanted to see what happened if we broke out of the bottom of this trend channel, and what has transpired is the exact opposite of what we want to see. We wanted to see a spike with low volume, with a divergence that would just be immediately rejected and pop right back up into this range, and that's not what happened. So I think we're going to challenge these summer lows, and I think we're going to most likely break them, and we're going to move forward. Remember, in the wheat market, we are tight on supply, but the reality is that wheat bought the acreage that it needed in order to meet future demand needs. And so now that the market has the acres, and even though we're still in a drought, and even though we haven't grown the crop yet, the futures market's going to start discounting that in order to make sure that demand is present and available to buy it. Remember, it's a futures market, not a present market, and so that's what it's doing. That's its job. This is also warning us and telling us that the Ukraine situation is absorbed into the market, and for weeks and weeks and months, we've hoped that that would continue to provide some support, which it has, but the market's absorbed it, and frankly, it's done its job. So now it's our job as traders and market participants to jump on board with it. So we're going to sell a small rally back up into here, and we're not going to look anywhere but forward, and we're going to trade it a day at a time. And obviously, you saw this last week with us, is that if the market changes and price action dictates it, we will change in a heartbeat, and we will we will tell everybody exactly where we're at. If you're new to this business and you're relatively new to trading and to farm marketing, it's not wishy-washy to go with price action. When the market is difficult and choppy, and it moves and then changes direction quickly, that's not a time to dig your heels in the sand and say, oh, the market's wrong, I'm right. That's not what you do. You have to just jump on it and go with it. And we struggle with it too. But what we're trying to do is really simplify these systems, because simple is way better than complicated. So we want to pick a point and we want to trade from it, right? And our point on wheat is certainly 905. I think it's more like 860, because this thing's gonna move on lower over time. And so the way we're going to trade wheat, and this is how we're going to wrap up. What I want to do with wheat first is I think we're going to sell puts today because of this 13. And as long as we're trading above this trend line, I'm going to sell a put. And we're going to try to catch a small rally up into here. I'm going to buy the put back. I'm going to sell a call, and I'm going to buy another put up higher. So we're going to try to cheapen that position up for us in order to get a nice true hedge right in here at relatively low cost. But I don't want to come in and step in and try to buy futures and catch a rally. If anything, if we don't get a put sold, we'll wait and we'll sell futures against a point. But I think we might be able to pick up a little bit of premium and then reverse it, pick more premium up and enhance that position pretty well, and then get long a put onto the downside. So, hey, we've identified the direction, we've identified the bias and where we want to go. Now the art of the business is what position are we going to put ourselves in and how are we going to manage it? And it's not as simple as, I'm short futures, I'm long futures. It's really more complicated than that in the marketing world on a crop that you don't know how much you're going to grow, and we have no idea what the weather's going to do in the future. So we want to be responsible, and we want to make sure that we're managing that position with all those factors in play, and that really forces us into option positions moving forward with wheat. So that's what we're going to look for. That's what we're going to do. Remember, there is risk trading commodity futures and options, and if you are doing so, you should do it in light of your own financial condition. And if you need to talk through position or anything specific on your farm, please call us. We're happy to talk through it at any time and help you get positioned the way you want to be for your risk tolerance. Hope you guys have a great week. We will talk to you next Wednesday and as needed the rest of the week. We'll talk to you later.